And Anthony asked a question related to what's called the stock repair tool. The stock repair tool, he says, when you're doing this stock repair, when do you exit the trade? Is it when the short strike is hit or when the short strike is at expiration? Well, that depends on your goals and it depends on your situation. We saw Apple take a little fall today. We're going to talk about that for Alice in just a little bit after Robert's question and another quick session from Stefania. But let's go to Apple, and we're going to go to the stock repair tool. And Apple ended today, I think, just below 150. I saw it at 149, somewhere around that range. But let's say I have shares of Apple at 156. Not too bad. It was a $7 decline on this case. It's about a 3.5, 3.6% fall. Okay, it ended it right at 149. What this tool does is it very quickly built a ratio call spread for me, buying one and selling two at a higher strike to receive a net credit, drastically lowering my break even. I don't need Apple to go back up to 156 now. I just need it to go to 149.80, not too far away from where it was after about the 3.5%, 4% decline today. Right? So how does this work? When I hit repair details, it shows me that I could buy an October 145 call at 740. At the same time, I can sell two October 150s for 440. So I take an 880. That gives me a net credit of 140. Well, wouldn't that put my cost basis at 154.60? The 140 minus the 156. How am I at break even at 149.80? Well, at 149.80, I've got a $6.20 loss on the stock from my purchase price of 156. At October expiration, if the stock's at 149.80, my 145 call is worth intrinsic value at 480. My 150s expire worthless, and I keep the net credit. So selling to close the call for 480, keeping the 140, selling the stock at 149.80, I'm at 156, and I'm at max profit for the repair. I'm at break even. I've solved the loss on this position. Of course, if it goes up a little higher, I can make a little profit of 40 cents. Well, how does this work? Isn't this dangerous? A ratio call spread, just related to that discussion we had with the naked calls. Why are naked calls risky? Well, it requires margin, of course, to put that up, and we have unlimited risk to the upside. But this is not a naked call. This is not a ratio call spread. This is you did enter a ratio call spread. You sold two and you bought one. But really what this is a covered call position, your 100 shares of Apple to 150 call mixed with a bull call debit spread that overall you got a credit for 140 on the position. That did lower the over total all cost, but what happens when the stock moves up in price? Now as the stock moves up, and we would only do this if we were bullish on the position, let's get a better view there. This isn't a great repair, but it's there. And so what happens is you see this acceleration going on right here. That's because I'm gaining back on the stock and I'm getting the profit on this long 145 call that's gaining in price. It's accelerating faster than the stock position because I'm getting near full profit on the bull call debit. And of course, I'm gaining back on the stock position. So to the question, when doing a stock repair, when would you exit the trade? Well, as you see here, the curve line, the halfway point on around September 29th, I'm not going to be at a profit because the time value is still remaining on those two short calls. So I wouldn't close this early unless I got near here. That would be up at 160, 165. You do want to wait closer to expiration in this case, Anthony. But let's take a look at a slightly better repair that's maybe further out in time. Okay, so I'm going to narrow this down. Let's look at this November. I want to go to the November one real quick. Similar process, difference 145, 150 out to November, little higher net credit, little better break even in this case. Not too much profit, but let's swing this over here. 1.9% return, but we're out to November. You see, even on October 18th, if the stock's moving back up and is 5 points here, Anthony, at 155 above my short call strike price of 150, not near profit yet. It needs to go higher. But Keep in mind what's happening here. You are, if let's say October 18th, halfway point, the stock is at 155. What's getting closer? It's not total yet, but what is getting closer to max profit? This 5-point debit spread. What else do you have? What is the other component here? It's a covered call. So Anthony, as the stock starts to go above the short call strike price, now that the trend has changed and moving in the direction that you wanted, not only to get back to break even, but also going in the direction and the trend you'd want for a covered call, neutral to bullish, you could consider just buying back one of the 150 calls and treating it just as a continued covered call position, and just leave that bull call debit there till it gets closer and closer to maximum profit. You're now back to managing a covered call by rolling the call and taking the profit on that bull call debit, which would, the full profit, of course, occurs at expiration. It's better to wait closer to expiration, which is why, even though sometimes a stock repair is available, going back to our discussion on the naked puts or rolling out the covered call, rolling to a covered call after taking assignment on the naked put position, if my only opportunity for repair is out to January, out to December, and yeah, it gives me a much lower break even that's much more reasonable, 148.57. I'm essentially there right now, but again, I have to wait to expiration, 70 days away to November. If my loss wasn't that much to begin with, maybe just close the position, take that 3 or 4% loss, and maybe look for a new stock. Of course, if you're down 10, 15%, you might not even see a repair, but a lot of the repairs that are available, if you're down 8, 10, 12%, will be out 70, 80, 90 days to give you the better premium to get the repair that you want. And in which case, you're going to have to wait to closer to expiration, Anthony, in order to see the profit. But if the stock exceeds your expectations, moves back up above that short call strike price in the stock repair, then I would consider just buying that one call back, Anthony, treating it just as a covered call, and continue to roll the covered call as you would if you didn't want to be assigned, you wanted to hold the stock, and as you would continue to keep rolling the covered call. Leave the bull call debit there until you get closer to an 80, 90% profit on the position. That's how I would approach it. That's how we approach managing the stock repair in that case. What is the one flaw with the stock repair, as unique as this is? Same thing that we talked about a moment ago for Stefania. It gives you a little credit, but it doesn't address the downside. If the stock continues its slide downwards, you can buy these calls back cheaper, but now you're losing on this cost that you paid here. Okay, you might be able to close for a credit if it's a big enough decline, but what are you doing? You're losing more on the stock than you're gaining on the premium between these two repair positions. So you got to evaluate now, should I just get out? Should I stop the bloodletting? Should I create a collar at some point or a married put to stop the bleeding? It won't repair it right away, but it could stop further bleeding, or just get out and look for a new position. But again, the management, wait till as close to expiration as possible. Maybe look at that bull call debit spread portion here as a separate entity. And if you reach to an 80% profit of what you expected to make, maybe take that off the table and then continue to just roll one of those two short calls. If you want to stay in the stock, continue to generate income as you would with a covered call that's moving up in price and has gone above your short call strike price.